and welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on the S&P 500 financial sector, and our guest is Amy Kong, the Chief Investment Officer at Barrett Asset Management. Well, the S&P 500 Financials Index was the third best performing sector last year, behind energy and real estate. The sector recovered as it became clear that the loan losses as a result of the pandemic would not be as bad as some had feared. But it was also squeezed by perennially low interest rates, which hurt margins, and that drove some investors into other sectors such as technology. But is that about to change? The US Fed has not only indicated interest rates may need to rise more quickly than expected, but that it may also need to start winding down its balance sheet in order to try to tame inflation. JP Morgan CEO Jamie Dimon said yesterday he thinks it's possible inflation is worse than people think, and the Fed may need to raise rates more than 4 times this year. All the talk of higher rates sparked a mini rotation in the first week of the year, from higher-priced technology stocks into cyclicals, including banks. So, what's the outlook for this sector? Let's ask Amy Kong at Barrett Asset Management. Amy, hi. We've been here before talking about the potential benefits of rotation for banks. So, what's your view?
Hi, Elena. I think it's a bit of deja vu. And to your point, when you look at last year versus this year so far, the banking sector is off to a really good start. Now, last year, we were obviously coming off of a very strong part of the recovery, and the cyclical sectors are definitely the winners last year. And this year, I think inflation is steering that rotation a bit more. So I'm not surprised to see that momentum continue. To your point, we also are seeing that there's a lot of bleeding in tech sectors, for example, and that is certainly helping the rotation. So going forward, I think as we continue to focus on monetary policy, I think financials definitely will continue to benefit from this tailwind. But as we get into the Q4 earnings season, which is going to start in a couple of days, and with tech sector stocks potentially still showing some growth, that bleeding could stop, and so the rotation could die down a little bit. But I think overall that momentum should still be pretty relevant into 2022.
But what could the cutting of the Fed's balance sheet mean for this sector?
Absolutely. And that's something we're watching very carefully. In the last FOMC meeting minutes, they did talk about reducing the Fed balance sheet. We don't have quite a lot of detail in terms of how they're approaching it. Certainly, the Fed can just sell things off their balance sheet, which is a bit more aggressive, but they can also just let issues roll off, which is essentially if a bond matures, they don't reinvest it. This is exactly what they did during the last rate hike. And I would imagine if inflation data points don't get worse from today's levels, perhaps the Fed may utilize this latter approach just to keep things more gradual and not be too aggressive and not to do too much at one point. And so I think it's something we're going to be watching pretty carefully. And, if that were to happen, that could also steepen the yield curve a little bit more, which I think could be a net positive for banks.
Earnings season, of course, starts this Friday with numbers out from Wells Fargo, JP Morgan and Citigroup. What are you expecting, and what kind of guidance are you looking for from the big banks?
We enter 2022 with still a constructive view on banks. To review, last year was a really good year for bank earnings. Basically, the financial sector grew 60% in terms of earnings in 2021. Do I expect that to repeat in 2022? Probably not. And that's because while you do have the monetary policy shifting as a tailwind, there are some offsets. For example, while loan growth was mediocre last year, we do expect that to pick up a little bit this year, but banks may also have to start reserving for some of that loan growth. And especially under the new regulatory CECL structure, those reserves could be higher than expected. And then at the same time, capital markets as a division, very, very strong last year, record M&A, IPOs were again at high levels. Will that continue into this year? We expect that there could be some normalization in the capital markets segments. And so again, you've got some tailwinds, but you've also got some headwinds. So overall, actually, the consensus is expecting, between 5 and 10% reduction of earnings into 2022. So we'll continue to watch that. And obviously, depending on how many rate hikes we're seeing in 2022, that could be a bit of that could actually offer some upside potential in terms of bank earnings into this year.
Amy Kong, CIO of Barrett Asset Management. Well, before I go, here are some of the top stories in this space. US Federal Reserve Chief Jerome Powell told his renomination hearing before the Senate Banking Committee that he thinks the easing of supply constraints will result in the easing of inflation over time, but with this caveat.
I will say, though, if we see inflation persisting at high levels longer than expected, then we will, if we have to raise interest rates more over time, we will.
His comments come a day before CPI data that may show prices rising at their fastest pace since at least the early 1980s, increasing the likelihood the Fed will raise rates as soon as March and may even need to wind down its balance sheet. China's property sector saw more drama on reports that developer Shimao had put all its projects up for sale, just as China Evergrande tried to avoid another high-profile default, while another debt-laden developer, R&F Properties, said today it would avoid default with a $725 million bond due on Tuesday. Shimao denied the report, but did say it was in talks to sell some of its properties after it defaulted on a payment of about $101 million last week. China Evergrande, meanwhile, said it's extending the period for its bondholders to vote on proposals to delay the redemption period on some of its bonds. And JP Morgan's Jamie Dimon says unvaccinated staff in New York risk losing their jobs. He said, quote, "If you aren't going to get vaxxed, you won't be able to work in the office, and we're not going to pay you not to work in the office." Last week, Citigroup said staff in the United States who have not been vaccinated by the end of this week would be placed on unpaid leave and fired at the end of the month. Well, that's your roundup of the US financial sector. I'm Elena Casas, and this is Reuters.